Hi, welcome to NoMortgagePayment.net. My name is Charles, and today we have a video presentation for you that will help you to get more money out of a refinance or to save money on a new mortgage. And we like to call this the mortgage success factors. So let's get into this right now. Lending is tight in today's mortgage landscape. Banks have been bailed out, and now they're running at a profit. Banks are making it harder for individuals to receive money for purchases of real estate, and they're making it almost impossible to refinance. Many people are looking for mortgage relief, and most lenders are simply not willing to help them. If you believe it's impossible for you to get money for your home through a refinance, you're part of the majority. The truth is that you can get approved for a new mortgage or to refinance your current mortgage. All you need is some simple things for your lender to approve you, and you can actually get some great deals since the rates are at an all-time low. Here are 3 factors for you to get a great mortgage rate or more money out of a refinance. The first mortgage success factor is income. Lenders do look at your income. How much money you make could be the difference in you getting approved or rejected for a mortgage. So ask yourself this question. How much money should you be making? Normally, lenders will look at your monthly taxable income versus your monthly household debt. This is called your debt-to-income ratio, or DTI. Now, debt-to-income ratio can be defined in 2 ways. The first DTI is what's called the front-end ratio, which indicates the percentage of your income that goes towards housing costs, such as your mortgage, insurance, and taxes. The second DTI, known as the back-end ratio, indicates the percentage of your income that goes toward paying all recurring debt payments. The second DTI includes everything covered in the first DTI. The second DTI also covers other debts, such as credit cards, car loans, student loans, child support, alimony, and judgments. For you to qualify for a mortgage, the actual limit that's in compliance for lenders is a debt-to-income ratio of 28/36. The first portion of this ratio is what lenders allow for housing expense. The second portion is what lenders allow for housing expense plus recurring debt. In other words, it's the first DTI over the second DTI, or the front end over the back end. Now let's look at an example to show how this works. Say your yearly gross income is $50,000. What you do is you divide $50,000 by 12 months, and you get $4,166.67 per month income. Now let's figure out the DTI at 28/36. Now you have a monthly income of $4,166.67. You multiply that times 0.28 and you get $1,166.67, which is allowed for your housing expense. That's the front end. Now we'll take a look and calculate the second portion, which is $4,166.67 a month income times 0.36, which comes to $1,500, which is allowed for housing expense plus recurring debt. That's the back end. So if your household income is within this range, you should be able to qualify for a mortgage based on your income. The problem is that your lender does not only look at your income. Here are 2 other factors for you to qualify for your loan. Mortgage success factor 2 is credit. Credit is the part that can cause some real issues for people. Your debt is important when considering whether or not you can get approved for a new loan or a refinance. So ask yourself this. What should you look at when you want to qualify for a mortgage? First, look at your 3 credit scores from the credit reporting companies. Experian, Equifax, and TransUnion are the reporting companies you should be looking at. Take the average of those 3 scores and see what you get. Your scores will look like this to most lenders. 720 and above is excellent credit. 719 to 650 is good. 649 to 620 is good but at a high risk. And below 620 is considered subprime credit. Your credit score could be the difference in you saving or spending hundreds or even thousands of dollars on your mortgage. The approval of your mortgage will depend on the lender and their credit qualifications for a loan. If you are above score 700, you can consider yourself in a good place. But don't get so wrapped up in your credit score that you forget about these other factors. A good rule of thumb is this: pay your bills on time, keep your account balances low, and take out new credit only when you need it. This is important because you need to keep some debt and not pay all of it off. Lenders want to see how much debt you can manage. The third mortgage success factor is equity. The housing crisis has really crippled this portion of the mortgage equation. Most people don't have any equity left in their home, and even more people are upside down, which means they're paying more than what the home is worth. That does not stop lenders from looking at your equity. The equity that lenders are looking for is defined by the loan-to-value ratio, or LTV. The loan-to-value ratio is simply the amount you want to borrow divided by the purchase price. So let's look at an example to give you a better understanding of LTV. If the home you are looking to purchase is $200,000 and you need to borrow $150,000 to purchase it, then your loan-to-value ratio is 0.75 or 75%. So you took the amount that you needed to borrow, which was $150,000, and divided that by the purchase price, which was $200,000. In today's mortgage market, most lenders are looking for an LTV of 0.80 or 80%. This means paying 20% down and getting the other 80% financed by your mortgage. If you look at these three factors, you should know that if you have all three factors in place, you should be able to qualify for a new loan or a refinance of your current mortgage. These factors are not etched in stone, but if you have all three of these in line with what your lender is looking for, you should be approved. Not only should you be approved, you should save a lot of money on your mortgage. If these three factors are not in place, you could be spending a lot more money than you were looking to initially spend. Remember to take some time and shop around when looking for your mortgage. Just because one lender takes these factors into consideration does not mean that all lenders do. Remember the three mortgage success factors: your income, your credit, and your equity. That concludes our presentation of mortgage success factors. We hope you enjoyed it and got something out of it. Remember to visit us at nomortgagepayment.net. You can also find us on Facebook and Twitter as well. And we look forward to seeing you in the future. Have a wonderful day.